Hello and welcome to Publishing Essentials for LitMags, a series of webinars created to deliver a foundation in business skills for arts, literary, and other small magazines. My name is Joyce Byrne, and it's my pleasure to produce Publishing Essentials on behalf of the Alberta Magazine Publishers Association. In today's lesson on budgeting basics, we are pleased to welcome Sharon McAuley. For the past 14 years, Sharon McAuley has excelled as a publishing consultant. She specializes in helping magazines form a deeper connection with their audiences through editorial content and transform their businesses to meet the challenges and opportunities of a changing world. Sharon honed her knowledge and expertise over 20 plus years as publisher of a variety of magazines and digital media, including Toronto Life, Saturday Night, Quill and Quire, Ottawa Magazine, and Wear Canada, as well as investment, executive, and IE Money. Over her career, she has worked with more than 50 Canadian arts, literary, and lifestyle magazines as a Magazines Canada traveling consultant. Sharon is a graduate of the University of Toronto with an HBA in English and holds an MBA with distinction from Ivey Business School at Western University. Please welcome Sharon McAuley. Over to you, Sharon.
Hi, everyone. I'll start with full disclosure. I'm not trained as an accountant. And I imagine if you're watching this, neither are you. What I've learned over my 30 plus years as a magazine publisher is that understanding and using your financial information is the foundation for making good business decisions for your magazine. If you're not sure what the numbers mean, or if you're not confident that you're asking the right questions, this webinar is designed to help you speak the language of accounting and use this skill to become a more effective decision maker within your organization. The main focus of this webinar will be on building out a magazine budget for literary magazines. But the same principles apply whether you're working for an arts and cultural title, a consumer magazine, or a specialized trade publication, or whether your organization is set up as a registered charity, nonprofit, or for-profit company. Before we dive in, though, we'll look at how your annual budget fits into the bigger picture of the yearly planning cycle to understand how your budget is just one component of how you manage your business throughout the year. We'll also go over some key accounting terms that you'll need to know to speak the language of accounting. And finally, we'll look at how to use income statements to monitor performance and forecasts to make adjustments to keep you on track for the year. A budget tells the story of your planned activities for the year, showing your best estimates for revenues and expenses for each area in your magazine, such as editorial, production, circulation, and admin. But before you can put together an operating budget, you need to start with an overall strategy and how that breaks down into a plan for the upcoming year. And once you have a budget, the real work begins as you implement your plan and monitor how you're doing. Let's look at the planning cycle in a little more detail. Starting at the top with the big picture strategy. What are we trying to achieve? Break that down into a plan for this specific time frame. What will we do in the next 12 months to achieve our goals? You then create a budget to show what this year's plan will cost, and importantly, how you'll fund it. A new year begins and you're carrying out your plan. You're publishing issues of the magazine, maybe running a literary contest, testing a new subscription offer through your website, maybe running a donation campaign or two. Here's where you use monthly or quarterly income statements to monitor how you're doing compared to your budget and analyze any differences. What's changed? Where are the risks? It helps to create a year-end forecast using the actual financials to date and then flow in the remaining budget numbers for the rest of the year. Where will you end up? And at this point, you may need to make some decisions. What do you need to do to stay on track? Subscription, donation, and advertising revenue can be uncertain. Grant funding is a fixed amount. How can you adapt your spending or bring in more revenue to improve your financial position so that it delivers on your original budget? It's your job to figure it out and take action. Like any language, it helps to learn some vocabulary. Here are some key concepts that come into play as you build your budget. Calendar year versus fiscal year. This can get confusing. The 12-month period for your budget is based on your organization's fiscal year. It could be the same as the calendar year and run from January to December, or it could be based on a different time frame that aligns more with your organization's activities or funding cycles. For example, from April to March, which is a common time period for nonprofits. Sorting this out is important. Find out what your fiscal year is and use that period for your budget and financial reporting. Accrual versus cash budget. This is particularly important for magazines. An accrual budget shows revenues when they're earned and expenses when they're incurred in the year. A cash budget records when money comes in or goes out. And this is used mostly for managing cash flow to fund operations. In your case, you're going to be using an accrual budget, which is what the majority of companies use to manage their operations. The matching concept is another important concept to use in your budgeting. Be sure to match revenue with the expenses required to generate it. So for example, your spring issue printing costs should be in the same budget month as the spring issue revenue. Earned versus deferred revenue. When you have paid subscriptions, you create deferred revenue. They've paid for the service in advance. Earned revenue is the revenue you earn when you deliver the product or service that was paid in advance. So for example, if someone is paid $24 for a subscription for 4 issues, you only earn or recognize $6 every time you produce a publication and send it to them. Having the lingo is more real once we look at an actual budget. I'm going to switch over now and show you our sample literary magazine accrual budget for 2026-2027. In this part of the session, we'll actually dig in deeply into the structure of a budget. And some of those terms will come into play as you'll start to see that we've created an accrual budget for our fiscal year, which runs from April until March. I find when I'm building a budget that it's very helpful to put in what the issues are that are published during that time frame and to put them in the month when they're delivered to the public. So in this case, this is a quarterly literary magazine, our sample, and they publish in June, September, December, and March. Just looking at the moving parts of a budget, we have 2 sections, revenue and then expenses. I'll go into each area in more detail. For accounting purposes, each account has an account number, and this is what is used to track revenue and track expenses, create reports for you, and all of this information goes into a general ledger. For your purposes, when you're budgeting, it's helpful to understand what the account numbers are used by your bookkeeper or the accounting firm that's managing your finances. That way you can be absolutely precise about where the revenue is going or where that expense is going. I often want to start with putting in the magazine revenue as the way to begin your budget. You can build your budget based on what happened last year, or there are some organizations that start from scratch. It's sort of zero-based budgeting. The main thing is that you are looking at what your plan is for the year, what the activities are that you hope to carry out, and what the related expenses and revenues are for that. So let's start with your print publication. This is earned revenue. And according to the matching principle, we're going to match it to the issue where you have delivered the service to the subscriber. Earned revenue can be a challenging thing to figure out. The easiest way is if you have a fulfillment service that provides you with that report that breaks out at any different issue point how many subscribers there are and how much they've paid per copy. Why this is challenging is you probably have subscribers starting at many different times throughout the year. They may be taking a 1-year subscription or a 2-year subscription, and so they're paying different rates per copy. And it's really a very complex building out of, for a particular snapshot of a magazine, of a particular issue, how much revenue that has been generated and how much revenue is left over in that subscription that's called deferred. In this case of the sample literary magazine, I've based it on a magazine that has 1,300 paid subscribers. They pay $35 a year for 4 issues. And I've just done the simple math of taking that 1,300 times $35 divided by 4 issues. So I've really, really simplified this process for the purposes of this exercise. And maybe given the size of your operation, that may be the way to go for you, but it doesn't necessarily reflect perhaps the complexity of having different subscription rates and having people starting at different times of year. Magazines have been moving into selling digital subscriptions. You may want to split that out or you may not. It depends on the complexity of your organization. And the key about setting up your budget is you want to split out and identify things that you want to track. Because if it's folded into a larger category, you can find that information, but it takes a lot of work sometimes to dig it out. So if you put it in your budget, if it has a particular budget line, you will always be able to get that information to monitor it, to see how you're doing. And if it's important to you strategically, I'd recommend that you actually do work with your bookkeeper to make sure that you are splitting that out and tracking that information. These accounts, which are set up in something called a chart of accounts, follow general numbering principles for accounting. Like the 4,000 level is usually revenues and the 5,000s are costs of goods, and 6,000s can be salaries and admin. But really you have some flexibility within that to how you split them out, what categories you're naming. So it's strategic. And as a business leader, as someone, a magazine leader who's responsible for this, it helps to speak the language and have that conversation to make sure that you are tracking what you need to track, particularly when it comes to things like your funding applications, where one of the line items is, how much do we pay freelancers for the year? You need to be able to split out that information in your budgeting, in your accounting, in order to get that information. It'll make your life so much easier from a monitoring situation, from a grant application situation, and from giving you, as I said, the ability to make decisions based on getting intelligence, getting the numbers you need to understand how your business is doing. Back to revenue. Single copy sales are a factor and are problematic in the sense that you get paid months after the fact for the sales of those publications on the newsstand. You're not operating a large operation. You're not selling a lot of copies on the newsstand. So from an overall budget perspective, we're not talking a lot of revenue here. I've seen budgets where it's a simple, straightforward, we put out 300 copies on the newsstand. We sell 30% of those copies at $15 and we get 50% of that back from in payment months after the fact. So in this case, I've just put that in, anticipating that the summer issue, we're going to sell 30% of 300 copies, and the same for the fall and the winter and the spring. If you want to, if you have variability and you want to record that in your budgeting, you can certainly do that. With some publications, they only put in the amount that they expect to receive, and then they have another line that's a adjustment for what they actually get. I won't get too fussy about this. In this case, we're talking $2,700. This is probably the easiest approach for budgeting. If you receive advertising or have a sponsorship, you can put that in based on what your expectation is. In this case, this sample literary magazine has someone who pays $400 for the outside back cover. Any digital advertising, again, split it out if you want to track it. They receive some money leading up to their literary contest in October and November, and they're running ads and promos on behalf of the sponsor of the literary contest. With literary magazines, a key part of your overall revenue structure is other revenue, and that would be funding that you receive. In this case, the sample magazine splits out different levels of funding that they receive from federal, provincial, and even municipal or regional. You don't have to do that. You can have just one line that says government grants. Again, if it's important to you to know and to track at the different levels, then go ahead and go provide that level of detail. Funding can be challenging to budget for. In this sample example, it looks like they know what their funding is in advance, and they've split it out throughout the fiscal year. They've just divided it up. If you aren't in a situation where the money comes before your actual fiscal year, if it comes in the middle of the year, then what I would recommend is simply budgeting the total amount in the anticipated month when you would receive the funding. At least it's being recognized that way. And usually what happens is it just gets applied to the activity that's come before. But it's a better way of maybe understanding what the timing is, and also understanding what your cash flow situation might be if you're not going to get that revenue until, say, January, where you have 2 more months left in your fiscal year. If you are a registered charity and you are going after donations, you may want to split out between individual donations that receive tax receipts, as well as perhaps you're receiving funding from other charities or foundations. Some magazines are in the fortunate situation where they have an endowment or there's an investment fund that throws off a certain amount of income every year, and that is used to fund operations. In this case, you would put it here. It is challenging if that investment fund fluctuates based on what's going on in the market. Hopefully, you're not in any risky situation, but having that steady source of income through the investment is really helpful for a lot of literary publications if they're fortunate to have that situation. If you have other means, other programs that bring in revenue, this is where you would put it. In this case, this literary publication runs a contest every November that brings in about almost $3,000 in contest entry fees. And so that's where they've budgeted. As we look at this, because the grants have been spread out over the entire year, it's a fairly consistent revenue amount each year for a total of about $335,000. I would suspect that's fairly typical, although this particular sample seems to be receiving grants from every level, which is no doubt very helpful in how they continue to operate. From the revenue side, we're going to look now at costs, expenses. And there are 2 ways of doing this. In some cases, publishers will simply run all of their costs down as operating expenses. as seen here, or they separate out their variable costs or the costs of actually printing and producing their publication from their operating costs, which are all the expenses needed to support the creation of the publications. So I'm going to show you this method called cost of goods sold. It's sometimes called cost of sales. And here's where you put your direct costs for producing the publication as opposed to your indirect costs. Printing, your mailing house, your postage for the publication, your contributors' fees, and your photos and illustrations. This will give you a gross surplus or deficit if you subtract it from the total revenue. And you'll see that essentially you have to break even. All the rest of your expenses have to come in at under $270,000. The other thing that I want to point out is the matching principle, where this is the summer issue. Here's the revenue for the summer issue. And here are the costs of producing the summer issue, the direct costs. I'll also point out that these particular accounts, contributor fees, photos and illustrations, are usually the main building blocks for your applications to funding, especially aid to publishers, for example, or Canada Council. Right. The next chunk are all of the indirect expenses, and they make up the significant portion of where your spending is. I haven't completed it, but what you would be doing is building out your budget based on a schedule of your employee salaries, benefits if they receive any, if you plan to have any contract help, or if you have any professional fees. For example, if you were hiring a designer to create your 4 issues. Again, thinking about your plan for the year, are you going to be doing any sales and promotion, marketing and promotion, for advertising, anything for circulation marketing? Here's where you would put costs if you hire a fulfillment bureau to manage your customer subscriber database. If you have any costs related to a circulation audit or a verification of your numbers that's used to submit to the Aid to Publishers program, for instance, those costs would go here. And if you have any fundraising costs, if you are an organization that does donation campaigns or other activities. I know some publications have arrangements where they run bingo nights, for instance, or other activities that are not related to the magazine itself, but still provide revenue. And here's where those costs would be. Now, these costs would relate to some of the other revenue that you receive here. So for instance, your contest entry fees revenue in November, you may want to have some costs related to added here, the contest entry added here. The general and administrative fees expenses are fairly static. You know what your rent is, you know what your legal fees are. If you have liability and director insurance for your board members, those costs would go here. But there are some discretionary spending within that. So perhaps you set aside some money for professional development. Maybe you're attending a conference, you would add a travel fees and meals and entertainment there. But most of these expenses are just built year over year from your previous budget. What your cost is for your computers and internet, software support, rent and parking, building insurance, maintenance, and utilities. Once you've flowed all of this information in, and for the purposes of this webinar, I won't be completing it, your net income as a not-for-profit publication should be close to break even, if not a slight surplus, but that may not be possible. The main thing is that you are not putting yourself in a deficit situation where you're not able to fund the gap between what your revenue is and what your expenses are. You have created your budget. You've managed to break even. In order to get to that point, you may have had to change some of your plans a little bit, what you're planning to spend, say, on circulation, or maybe you decided that you won't be going to that conference after all. Whatever it is, you are presenting the budget to your board, it gets approved, and you're on your way. Thinking back to that planning cycle, the next part after the budget is implementing your plan and then monitoring your performance. The way that you monitor how you're doing is through the income statements that you get from your bookkeeper that show the activity within a certain time period. It may be monthly, it's probably quarterly that you will see. And from there, you can see whether there have been any changes. As we had noted earlier, it's a dynamic business environment out there. Advertising and subscription revenues can vary significantly. Maybe the timing has changed on some of the things that you decided to work on. Maybe the funding that you had expected came in at a few $1,000s lower than you had hoped. The point is that these numbers are tools for you to make business decisions. And it begins by creating a forecast where you use the actual numbers from your income statement as your starting point, and then flow in the budget numbers remaining for the rest of the year. Where does that leave you as you look at that? If you're in a worse financial position, the question is, how can you adapt to make up for any significant changes? Your forecasts are really a kind of do-over, and they're a way of reflecting the fact that we're working in an ever-changing world, and your strategy has to move and adapt and evolve in response to what's going on out there. So in your forecast, this is where you revise your plan and perhaps change your activities for the remainder of the year in order to make sure that you continue to stay on track. This doesn't just happen once. It's a iterative process, because your position after the first quarter in March may be different from where you are in the second quarter. Something may have happened in the meantime that brought in more revenue, or perhaps you found that something fell through and you're looking at a bit of a deficit. So I recommend that you repeat this throughout the year, through the first quarter, the second quarter, and the third quarter, to give you some visibility as to where you're going to end up at year end. I'll leave you with a parting thought, a literary parting thought, and it's by Charles Dickens and David Copperfield. Annual income, £20. Annual expenditure, 19,996. Result, happiness. Annual income, £20. Annual expenditure, £20 not in 6. Result, misery. I wish you all happiness as you undertake the budgeting process, and the best of luck as you implement your plans throughout the year. Thank you.
I have a question for you, Sharon, related to process around budgeting and process around managing your bookkeeping as a small magazine publisher. What is a good cadence and timing to get into around reviewing your budget to actuals? And if you're doing your books yourself, what's a good cadence to get into for doing your bookkeeping? How can we be better at using these tools and this tool?
I think the cadence is determined by what your publication schedule is. And it's also determined by the amount of activity you have throughout the year beyond just publishing your title. So if you have other programs that are running and they're not happening in publication months, I would recommend that you're actually trying to do your bookkeeping and keeping up on a monthly basis. If those other programs are limited and your primary activity is built around publication and your publication schedule, I would recommend you're doing it every 2 months if you're publishing 6 times a year, or quarterly if you're doing it 4 times a year, because that's when the major moving pieces are happening. Your major expenses are happening, and that's when your revenue is coming in. What I would really caution against is letting things slide, because I know it's hard to keep up, but having a built-in time frame when you sit down and you do the books and you enter in the information, you're using the reports that you're gathering from people, you're monitoring how campaigns are doing. It's not only a way of keeping track of things, but it's also a great motivator. It can be an early warning system. It can be a positive reinforcement that, hey, you're actually succeeding at what you set out to do. It's great for communication tool with everybody to keep the team on track, working with the people who are doing your, say, a paid subscription campaign. It's like, well, what's going on here? This is not exactly where we thought we would be. Why is there a difference? What are we going to do to make up for it? It's a starting point for communication and for good leadership and good management.
That actually leads me into the other question I was going to ask, which is about variances. Because this tool, if you're comparing actuals and budgets, can be really helpful in clearly delineating when things go a little bit off the rails or maybe a lot off the rails. How do you approach coming to terms with the variances do happen, and when should you be worried?
The first thing is understanding what the variances are and why. When you build your budget, it's your best estimate at the time. And it's probably, if you're ahead of the game, you're doing this 2 months out, maybe even 3 months out before your actual fiscal year begins. Who are we kidding? It's 2 weeks before. And you're working hard to consider all these moving pieces. There will invariably be variances because you are just working from the information you have at the time and stuff changes. I am a big proponent of knowing as early as possible when things are not what I expected them to be, because it gives me the ability to assess whether that's something to be concerned about or whether it's not something to be concerned about. Whether there's a logical explanation as, oh, we decided not to do our campaign in June because we realized that there's an opportunity in September to do a donation matching. So we're just going to move the timing of that. That's nothing to be concerned about. But if you had undertaken a major subscription campaign, for instance, and it did not deliver, you need to know that up front because you're counting on that revenue. So I would advise people to stay on top of, doing the books, getting the reports, and then, depending on your cadence, sitting down, spending time talking to the people who are managing those various areas of circulation, advertising, editorial costs, and walk through where there are variances, why. And then more importantly, and I learned this from a boss a long time ago, what are you going to do about it? Because you can't just shrug your shoulders and say, well, oh, too bad. This didn't work out and we're going to lose X number of dollars and we're going to be in this deficit position. You as a manager and as someone who's responsible for delivering on what the budget promised should try to figure out what the plan B is and get everybody on your team to help you with that.
Especially when some of that is tied to like a grant that may have come in, which may or may not be flexible around specific expenses or the scope of specific deliverables too, right?
Absolutely. And, I get it. We're not perfect, and we're also probably wearing many, many hats, you know? So this is not, I hope you don't consider this a burden if you're having to do this. I am the kind of person who sees it as a benefit because it gives you the tools you need to make the decisions you need to make, and you're not blindsided by anything.